Hi guys. For this video, we are going to continue with the monetary sector. This is part B of the monetary sector. And the lecture outcomes for this part is what we're going to be looking at is money supply and its various definitions, the role of the South African Reserve Bank, as well as the monetary policy in South Africa. Right. So let's get into it. Money in South Africa. So because there are several means of payment, it is quite difficult to measure money. However, in South Africa, there are three different measures which are used by the Reserve Bank to measure the quantity of money, namely M1, M2, and M3. So you need to know these measures. There are three different measures which are used to measure money in South Africa, which is M1, M2, and M3. Right. So M1, let me just go here. So M1, also called the conversional measure. This is the narrowest definition, and it looks at using money as a function of medium of exchange, right? The use of money as a what? As a medium of exchange. So M1 consists of the notes, the coins, and the what and the demand deposits. So here's an equation. It's C plus D. C for what? For cash. And cash consists of coins and what and notes. And then D for demand deposits. Demand deposits basically referring to for example, your debit card, right? It's money that is in your debit card that can be easily withdrawn and that can be used at any time, right? Which is why they say Kuti, it relates to the function of money as a medium of exchange. Because remember, with the money that is in your debit account, you can use it at any time when you want to, right? You can just withdraw it from the ATM. They give an example of EFTs. So what is very important here is that M1 is the conversional measure and also the narrowest definition, obviously because it focuses on the function of money as a medium of exchange. And to calculate M1, you basically add your cash, which is your coins and your notes, plus your demand deposit, which refers to money that is in your debit card that can be easily withdrawn and can be easily used, right, at any time when you need it. Right, so M1 is what? Your coins, your notes, and your demand deposits. Then you also have M2, which is a broader definition. This one is a broader definition because it consists of M1, right? So to calculate M2, you have to firstly calculate M1, right? So you need to firstly calculate what? The cash and the demand deposits, and then the sum of that, which is M1, you use that also to do what? To calculate your M2. So they're saying that here it equals to M1 plus all other short-term and medium-term deposits, right? So you just take the answer that you got from calculating M1, which is the narrowest definition of money, and then you're going to add your short-term and your medium-term deposits. Short-term deposits, that is money that you've invested for a period of less than 30 days, and medium-term deposits, that is money that has been invested for a period of less than 6 months. So sometimes they'll not tell you it's short-term deposits or it's medium-term. They'll just say it has been invested for a period of less than 30 days or has been invested for a period of less than 6 months. So now you know Uti, those are what those figures you're gonna add them together and then add them to M1 in order to get what? Your M2. Right. I hope I'm not fast, yes. Pronouncing fast. But yeah. And then M2, that is the broad definition. And it consists of you add M1 and then you also add your short term and your medium term deposits. So M2 is also called that's the cost money or near money. So sometimes when you get, we're gonna do the calculations after this video. I'm gonna make the another one for calculations. But sometimes they might tell you your short-term deposits was okay, they will not tell you your short-term deposits is how much, and they'll not even give you your medium term, but they'll just write cost money or near money, and then they give you the figure. So that's basically referring towards short-term plus medium-term deposits. And then they can call it what? Cost money or near money. But you're gonna see that when we do the calculations. So for this part, you just have to know that M2 is a broad definition of money simply because you have to also add M1, right? And M2 would consist of M1 plus your short-term deposits, which are basically the money that you've invested for less than 30 days, and your medium-term deposits, which is money that has been invested for less than 6 months. Right. It's also called cost money or near money. Then you also have the most comprehensive measure of money in South Africa. And also this one is regarded as the best measure simply because it adds together all the monies, right? It groups together M1, M2, and then plus long-term deposits. Remember, M1 consists of the what? The coins, the notes, and the demand deposits, right? And M2 is M1 plus what? Plus the cost money, right? Which is short-term deposits and medium-term. And then our M3, it's the only difference is that M3 is M2, which is the coins, the notes, the demand deposits, long-term deposits, short-term deposits, plus long-term deposits, right? So M3 is M2 plus what? Long-term deposits. And this one, it relates to the function of money as a store of value, right? Store of value. Remember what we said, Uti? We said store of value is what? We said that um a store of value, it basically means you preserve your purchasing power to use it at a later stage, right? Money is held and then is withdrawn at a later stage, right? That one of the function of money, which is a store of value. Money can be a store of value in the sense that it can be held and used at a later stage, right? So this broadest definition, it relates to the function of money as a store of value simply because um, you add what? The long-term deposits. And the long-term deposits, they have a maturity date which is longer than 6 months, right? So the maturity period is longer compared to your short-term deposits, which is like less than 30 days, and your medium term, which is like less than 6 months, right? This one is what is longer than what 6 months. So sometimes you also be given a table and then they wouldn't tell you what this is long-term deposits. They'll say what deposits with the maturity of longer than 6 months. So now you know, okay, if it's longer than 6 months, then that is a long-term deposit. It means that I'm going to use that figure to calculate what? My M3, right? Yeah, so here you just have to know that M3 is the most comprehensive measure of money and is the broadest definition. We said M1 is the narrowest definition and M2 we said is the broader definition. So M3 is the broadest definition simply because it grouped together all the monies, right, from M1 until M3, which consist of long-term deposits, right? Yeah, it is regarded as the best measures of development in the monetary sector. So financial intermediary. So I hope you guys got this one. M1 is just you add all your coins, your cash, which is your coins and notes, and then your demand deposits. I feel like you just need to know the calculations. And then M2, it's M1, and then you add your short-term or your medium-term deposits, right? Also called cost money or near money. Then M3, you add M2, you take M2, then you add your long-term deposits, right? Those that have a maturity of longer than what? 6 months, right? This is the best measure because it adds together all the monies in the economy. Then we have financial intermediaries. So your financial intermediaries, those are your what? Those are your commercial banks, right? Your commercial banks is what your Capitec, FNB, what else? Nedbank, Absa, and so on. Those are the commercial banks, right? They're called financial intermediaries. And they act as what? You can see they here in the middle. They act what? As a middleman between the what? The savers and the borrowers. Those that have what? Surplus units and those that have what? Deficit units, meaning that those that have money and those that do not have money. Why are we saying that they are intermediaries? Because financial intermediaries or they are middlemen because the people that have surplus funds, right? They save their funds, they deposit their money here, commercial banks, your Absa, your Capitec, and so on. And then people that need money, your firms, the government, and the households, they come here to these commercial banks to do what? To borrow money, right? So they are just what? The financial intermediaries. So what are they saying here? They act as intermediary between those who save or invest. So between these ones who invest or save and those who need to borrow money. So and these ones that need to borrow money. So they act as what? As an intermediary between those who want to save and those that want to borrow money. They further specialize in acceptance of deposits. Obviously, when these people save their money here, they're accepting a deposit when you deposit your money in the bank. and granting of credits, and they offer credit to these ones that want to borrow money. Yeah, so basically here they're telling us something that we do know. With Velama Bank, they are there to do what? We deposit our money there and save our money there. And then we also do what? We also um take out loans from banks, right? And they also offer us what? They grant us what? Credits, right? So financial intermediaries, okay, here they're explaining the same thing, but let's just read. They're saying that households and firms that have surplus funds save their money by depositing money into the financial intermediaries, such as banks. So you can see these people here that have surplus funds, they're gonna do what? Deposit their money here, comma financial intermediaries, right? And then such as banks, right? The financial intermediaries then lend this money that is saved to households, government, as well as firms by offering credit or securities, for example. So the banks then will then lend this money to what? To these people here, right? That then lend this money to what? To these people, to the firms, government, and the households, those that have deficit units, right? Those that need to borrow. And then in this way, so one might be asking themselves, why is the government not depositing money from the in the bank, right? Because you can see the government is only on this side. It's not here. The government is not on this side. The reason is because the government save their money with the what? With the South African Reserve Bank. That's where the government keeps their money. South African Reserve Bank, right? But they can borrow money from the what? From the commercial banks, right? So the South African Reserve Bank is the banker of the what? Of the government, right? So let's continue. In this way, financial intermediaries serve as a link between surplus units and deficit units in the economy. This is called indirect financing. So they're saying that now these financial intermediaries, they act as a link between what? Between these people here, the savers, those with surplus units, and those with what? Deficit units, right? The borrowers. And this is called indirect financing. So why are we calling it indirect financing? Because essentially these people here, they are being financed by what? By these people here, but indirectly because they get these funds from where? From the financial intermediaries. So for example, if this person here, the household, um deposits 100 rand here with Capitec, let's say this is Capitec, then this firm comes here to Capitec and borrows maybe 100 rand. Let me just make an example. Then Capitec gives this person 100 rand. So essentially, this firm is using this household money, right, indirectly because they got it from what? From Capitec. I'm not sure if I'm making sense, but indirect financing just basically means um the the borrower is indirect financing. It's when the borrower gets money from the what? From the financial intermediary, right? And then direct financing would be when now the borrower gets money exactly from the saver, right? For instance, if there's a student maybe on campus who is a loan shark, and I just go straight to the student to borrow money, that is direct financing, right? Because I'm getting it directly from a person that has surplus units. But now if I'm getting it from the bank, it's indirect financing because essentially I'm being financed by this person just via what? Via this bank, which is Capitec in my example that I made, right? Yeah, I hope you can understand. So direct financing is when the borrowers are being financed directly by our savers, and then indirectly is when the borrowers obtain financial assistance from what? From the financial intermediaries, right? Via from the households, but via what? The financial intermediaries, or um from the savers via what? The banks, right? Because essentially the person who's giving this the firm the funds is the households. It's just that he's gonna get it from the what? From the bank, right? Hey, I hope I didn't confuse you guys. So, okay, let's just read here what they're saying. They're saying that here, surplus and deficit unit can also enter into direct transaction. So they're saying that the surplus unit and the deficit unit, right? Those who want to save, who have surplus money, and those who do not have, right? can also enter into what? A direct financing. But this is led far more common than indirect financing. So they're also saying that the direct financing is not common compared to indirect. Because most people, if they want to borrow money, they usually go to banks. Because loan sharks, ama loan sharks, they're illegal actually. Yeah, ama loan sharks are illegal. So if you are one of the loan sharks and you're on campus and you're not registered, let me tell. Okay, so do you guys understand this part here? They're basically telling us with time of financial intermediaries, those are the what? The commercial banks, right? And the commercial banks, I gave you the types of commercial banks to say it's Absa, Capitec, and so on, right? They are just what? They are a link or they are a middleman or a middle person between what? Between the savers, those that have surplus funds or surplus units, and the what? And the borrowers, those that have deficit units, right? They act as a middleman because these people here, the savers, they deposit their funds here, and then the borrowers, sorry, and then they also provide what? Credit to the borrowers, right? Which is called what? Indirect financing. And then direct financing will be now where those with surplus units interact with the what? With those that have what? Deficit units, or finances provide finance to those with deficit units. The term that they use here, when they say that they can enter into a direct transaction. So where those with surplus and deficit units enter into what? Into a direct transaction. And then you go to the what? Now we're going to look at the South African Reserve Bank in South Africa. South African Reserve Bank. So the South African Reserve Bank, one thing that you know already is that the South African Reserve Bank is a banker of the what? Of the government. Because remember, I said here, Guti, one person might be asking themselves, Guti, why is the government not on this side? Does the government not have money to deposit into our into like banks? Does the government not have money? The government does have money, but they keep their money where their funds were in the South African Reserve Bank, right? But they do borrow money from the commercial banks, right? So the South African Reserve Bank is it is the central bank. Okay, let me just read here. Is the main monetary authority in South Africa, right? It's the main monetary authority. The South African Reserve Bank uses the monetary policy in order to do what? In order to regulate the money that is in the circulation, right? It regulates money that is in circulation. What? The South African Reserve Bank by using what? The monetary policy, right? So it is the main monetary authority in what? In South Africa. And it was established in 1920, but started doing business in 1921. Right. It is also the central bank of South Africa, right? It is the central bank. And the purpose of this bank is to achieve and maintain price stability in the interest of balanced and sustainable economic growth in South Africa, right? So the primary purpose is to do what? Is to achieve and maintain price stability and sustainable economic growth in South Africa, right? Price stability. I want to just explain this thing. You know, guys, price stability. So one of our lecturer was telling us that one of the students, when they were answering the question in test one, right? Remember, they asked us to name the um five macroeconomic objective, right? And someone wrote inflation. Yeah, I also said that once, right? I don't know if it was once, but yeah, I said that before. So let's just correct ourselves, right? So price stability, it does not refer to inflation only, right? It refers to price stability is just what this means is that we want to make sure that the prices are stable in a sense that we do not have higher prices or we do not have low prices, right? So we do not have what? Inflation, and we also do not have what? Deflation. So price stability is just, it has two terms attached to it, which is inflation and deflation. However, the lecture said that if you wrote that, you did get a mark, but then next time you shouldn't. You should just write price stability, right? So price stability has two things attached to each. It is inflation and deflation. So meaning that so this sentence here, maintaining price stability, means we want to ensure that prices are not high. We do not have inflation, and prices are not low. We do not have deflation, but prices are what? Are stable, right? not too high, not too low, but just fine. So yeah, we're talking about what the purpose of the South African Reserve Bank. So it's to achieve and maintain price stability and also sustainable economic growth. And then together with other institutions, it also plays a pivotal role in ensuring financial stability. So it also ensures what financial stability. And then the South African Reserve Bank, the role and its function. So what are the roles of the South African Reserve Bank? To formulate and implement the monetary policy, obviously because the one of the instrument used by the South African Reserve Bank is the monetary policy. So they have to do to formulate and implement this policy that they use, right? So under the monetary policy, we have instruments such as your repo rates, your open market transactions, your cash reserves, and yeah, we're gonna get into that. But those are the instrument of the monetary policy, right? Which is your cash reserves requirement, your repo rates, and open market operations or open market transactions. Number two, they maintain financial stability. So maintaining financial stability, they supervise banks to ensure that they adhere to the regulations. They oversee the national payment systems. They are the banker to other banks. So other banks, they also keep their funds with the with the South African Reserve Bank, right? So the South African Reserve Bank is also the bank to other banks, right? Is a banker to other banks, right? Yeah. And issuing and destroying of banknotes and coins. So we know this one, validity money is made there at the South African Reserve Bank, right? So they issue and they also destroy banknotes and coins, right? And then service to the government. So they also provide service to the government simply because South African Reserve Bank is the main banker here, is the main banker and advisor to the government, right? It is also a custodian of gold and foreign reserves, so it also keeps gold and other foreign reserves. Administration of exchange control. It also administers what the exchange control. So like when you are buying from Shein or other foreign countries, and then South African Reserve Bank is responsible for ensuring that money that you paid leaves the economy, right, and goes to that foreign country. It's a provision for economic and statistical services. It collects, processes, and interprets and publishes economic data. So the four functions or role of the South African Reserve Bank is to formulate and implement the monetary policy, right? They formulate it and they implement it. What's the monetary policy? Because yeah, and then under the monetary policy, it has its own instrument such as the repo rate, the open market transaction, the cash reserves requirements, right? It also maintains financial stability and it also provides service to the government since Vele it is the main bank of the government. And then it also provide economic and statistical services in the form of collecting, processing, and interpreting and publishing economic data, right? The stock of money, how is money created? So the role of banks in the money creation process. Bank creates deposits by making loans. Okay, this here they're saying the same thing that I said here, but I'm just going to read it, then I'm going to go back to the diagram and then explain. So banks create deposits by making loans, by responding to the demand for loans by borrowers whom the banker deemed to be creditworthy. So they only offer loans to the people that are creditworthy. So they wouldn't offer loans to just everyone. They need to check your credit score, check ukuthi, are you able to repay back this loan and all of that, right? If either borrowers or loans are deemed too risky, no loans will be granted and no money creation will occur. So if they see it's okay, they do a background check and they see it's okay, you cannot pay back this money, then no loan will be granted to you. Obviously, for example, I cannot go to the bank and like borrow maybe like 100,000. I mean, I don't even have okay, let me not say, but yeah, you get it. So okay, so essentially what they're talking about here is that money is created so how money is created is that banks will offer will make loans available to the borrowers, right? Obviously, they're gonna check your credit score, and then if you're credit worthy, they're gonna give you that loan. Maybe if you want 1 million, they're gonna give you that 1 million, right? And then, okay, let me just make an example. I'm gonna use like small amounts so that I can be able to remember. So I'm gonna say maybe let's say this person here deposits 100 rand, right? In this bank. Let's say it's Capitec. And then this firm comes here to Capitec and then they want to borrow what 100 rand, right? So Capitec is going to give this man 100 rand and then charge an interest of, let me not use the percentage, let me just say the interest is 50 rand, right? So when this person pays back, when this firm pays back the loan that they took from Capitec, it's going to be 100 rand plus 50 rand, right? So the 50 rand is the extra amount that has been what created by what? By the financial intermediary. So that's how money is created actually. Do you guys get that? Yeah. So that's what they're saying here. But banks create deposits by making loans, right? So when they offer, so when they make these loans, obviously when you pay, you're gonna pay with interest, and that's how money is created. And then money in the form of demand deposits is created by money creation process in two ways. Passive. Remember the passive balance, we said that when we were looking at the previous this slide also, but like when we were looking at what were we looking at? Um the passive where we said Duguti, you can use money for okay, no, why would a person hold money? We said Duguti for passive balance, it's where we said Duguti for transactional motive or precautionary motive, right? When you add those together, it gives us the passive balance, right? And we said Duguti that with the transaction motive, we said Duguti you holding money so that you can use it whenever you want to use it, like, right, for the purchase of goods and services. And it relates to using money to the function of money as a medium of exchange, right? And then for precautionary motive, we said it's where you just have money. You do not expect to use it, but when the need arises, you can use it, right? So passive money, they say with passive money, supply remains unchanged, right? Why? Why money supply remains unchanged with passive money? Obviously, because that is the money that you have at your disposal. You can use it at any time, right? You have it, right? But with active balances, we said Duguti, this one is it goes with speculative motive. We said Duguti, it relates to the function of money as a store of value. Remember, when we say Duguti speculative motive, it also goes together with the interest rate. If the interest rate are high, you would want to do what? To save your money because it's gonna generate more it's going to generate more money for you, right? Because you're gonna get interest and the interest rate is high. But if when the interest rate is low, you're gonna want to hold that money, right? Because obviously the interest rate is low. So with the active balance, money supply changes. It changes how if when credit is created. So let's say for example you have your money there in interest rate are high, so you keep your money there. Commercial banks, right? At the bank, right? Because active balances it relates to what speculative motive, where which we said Uguti, speculative motive, whereby now we said Uguti, it's related to the function of using money as a what? As a store of value, where you can keep your money, you can invest your money, right? If interest rate are high, you keep it at the bank. If interest rate are low, you take it out because obviously it's not gonna generate it's not gonna make more money for you, right? So it's best if you take it when interest rate are low. So when you have now deposited your money at the bank, credits can be what can be created. So the supply of money will increase because more money is there with the commercial banks. So now they have more money to do what? To lend out to people, right? That's essentially what they're saying here. With the active balance, remember refer we relate active balance to what? To the reason of where they said, why would you hold money? And then they said it's for speculative motive, which you said you want to invest that money so that it can, if the interest rate are high, you want to invest it so that you get more money. And then if interest rate are low, you withdraw that money, right? So if money is invested, commercial banks, the supply of money will change. It would increase, right? If your money is invested there. And then it means now that banks would have more money to do what? To 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 offer to people, right? Through what? Through our loans. And then credit will be created in that way. It's just the same with what I said here. Ukuthi, if this person deposits 100 Rand kuma financial intermediaries, banks would have more money to do what? To lend out to what? To the borrowers, right? That's what they're saying. And then the stock of money, how money is created are okay, so they're going to be repeating the same thing, but let's just read. Allowing a customer to have a demand deposits equivalent. So banks can create demand deposits. Remember demand deposits, we said Uguti refers to your what? The example is your debit card, which is money that can be withdrawn at any time when you want to use it, right? You can use it at any time. So bank can create demand deposits by allowing a customer to have a demand deposit equivalent to a cash amount deposited into their account. Obviously, the amount that you deposited into your account will be the same amount that will be in your debit card. If a customer deposits cash, that gets lent to a customer and a demand deposit is created for that person. So essentially what they're saying here is that if I deposit money, they're saying the same thing that I said there, but let me just explain it. So if I deposit money into a bank, right, and then another person comes and borrows money from the bank, that money will be removed from my demand deposit from my account and will go to that person's account. Then a demand deposit for that person will be created, right? That's what they're saying. And then banks may sometimes create excessive amounts of money. The Reserve Bank intervenes by using interest rate to influence the rate at which new money is created. So now, if bank creates excessive amounts of money, then the Reserve Bank can intervene. Remember, we said the Reserve Bank, it regulates the supply of money in the economy. So if they see that there's excess money in circulation, they would then intervene by using what? The monetary policy. And in the monetary policy, there are instruments that they use, such as the repo rate, the open market transaction, the cash reserves requirement, right? So here they're saying that if there's excessive amount of money in the economy, the South African Reserve Bank can use the interest rate, right? So what happens is that the South African Reserve Bank will use the repo rate, which will influence the interest rate, right? Meaning that, okay, we're gonna get to that one, but the South African Reserve Bank, what they use is the repo rate. The repo rate is the interest rate which is charged by our commercial banks to the banks, right? Remember that the by the South African Reserve Bank, I mean to the what? To the commercial banks. Remember that the commercial banks, they keep their funds away with the South African Reserve Bank. So also they are also charged what? Interest, which is called what? The repo rate. So if the South African Reserve Bank wants to influence the interest rate, they will use the repo rate or the repurchase rate, which is the interest rate that is charged to our commercial banks. So for this example, if there's excessive, sorry, for this part, if there's excessive amount of money, meaning that there's too much money in circulation. So to try and reduce this money, because if banks have more money, then if there's too much money in circulation, then banks are going to want to give out more loans and offer and grant credit to people easily, right? Because they have excess amount of money, right? And then that will lead to what? To inflation and all of that. So commercial banks would want to do what? To regulate that excessive amount, to regulate um the money supply in the economy. In that case, they would want to do what? To reduce the supply of money because the banks have what excess money. So what they would do is that they will use their interest rate, which in this case is the repo rate, which is the interest rate which is charged to what to the commercial banks. They will increase the repo rate. So if they increase the repo rate, banks will also do what? The banks will also increase the interest rate for us. So now it becomes expensive for us to do what? To borrow money from the bank. And then that will do what? That will then reduce what? The money, the amount of money that is in what? That is in circulation. Because now when it's expensive for us to borrow money, when the interest rate is high, we will prefer not to take out loans, but to save our money there at the bank so that it gains more interest. Right? Yeah. A growing economy requires a growing money stock, but too much money growth should not be excessive since it can cause inflation. So just what I said that if there's excess money in circulation, it's gonna lead to what? To inflation because people are gonna borrow money from the commercial banks. And then people have more money, have more disposable income in their hands. They're gonna use that amount of money to do what? To purchase goods and services. Then what happens? Let me just draw this diagram. I like it so much. So here, I just hope it's going to show each. You have your demand, you have your supply, then you have this is the price, right? Let's see now. This is your D, this is your S. Remember, I said it was now people have more disposable income, right? Because credits are cheaper. So we go to the banks, we borrow money. Um, the interest rate is low, so making credits to be cheap. So we borrow money from the commercial banks and all of that. Then what happens? The demand increases, right? Demand increases. But if demand increases, how are then the producers expected to do what? To fulfill this demand, right? Because they are still producing the same quantities. They would have to do what? They would have to do what? To increase the price. Then you can see now that the quantity which is demanded is going to decrease because the price has been what? Has been increased, right? So when the producers increase the price, it leads what? It causes inflation because inflation is a general increase in the prices of goods and services. So they can no longer keep up with this demand for goods and services. They then do what? They then increase the prices, which then leads to what? To inflation, right? The quantity of money is determined by the interaction of the interest rate and the demand for money. Okay, we said this in the previous slides where we see the quantity of money is determined by the interaction of the interest rate and the demand for money. Remember, we said demand for money is the quantity of money that people are willing and able to hold at a specific point in time, right? So the money that you are willing and able to hold, it will depend on the interest rate. If the interest rate is high, you would want to do what? To save that money, right? But if interest rate are low, you'd want to do what? To keep it. You withdraw that money, you use it, right? So the demand for money, the quantity of money that you're willing and able to hold, it depends on the what? On the interest rate. A reduction in the interest rate will increase the quantity of money and vice versa. So if the interest rate increases, the quantity of money will do what? No. If interest rate decrease, the quantity of money will increase. So money that you're willing to hold will increase if the interest rate decreases. But if the interest rate increases, you're gonna want the quantity of money that people are willing and able to hold will do what? Will decrease because now they'll prefer to do what? To save that money, to invest it, because interest rate are what? Are high, right? The stock of money, how money is created, the supply of money changes due to. Okay, so now we're going to look at the instrument used by the monetary policy. Remember, I've been saying, Guti, the South African Reserve Bank, it formulates and implements the monetary policy. And then under the monetary policy, the instrument that they used, which is the cash reserves, the repo rate, and the open market transaction or open market operations. It's the same thing, right? The repo rate can also be called the repurchase rate. right? So these are the instruments which are used by the South African Reserve Bank, right, under the monetary policy in order to regulate the supply of money in the economy, right? So they're saying here, but how does the central bank regulate this money creation? It uses the interest rate to influence the rate at which new money is created. The central bank tries, okay, here I think they are saying the same thing also, but let's just read. The central bank tries to regulate money creation by affecting the demand for loans. So, via the price of loans. Okay, I highlighted this one because the price of loans is the what? Is the interest rate. It can also be called the cost of loans or the price of loans, which is the interest rate. Because for taking out a loan, you have to pay a price, or there is a cost, which is what? The interest rate that you have to pay, right? Because if you take out 100 rand, you're gonna have to pay the 100 rand with an interest, maybe interest of 50 rand. So now you're gonna pay how much? 150. So that 50 there is a price of a loan or is a cost of that loan, right? Hence, there is no independent money supply. So there is no independent money supply, right? Because money supply, the supply of money is regulated by the what? By the South African Reserve Bank. Stock of money is determined by the interaction of the demand for money and the interest rate. I said this already to say, Guti, the demand for money is the money that amount of money that people are willing and able to hold. It's gonna depend on the interest rate. If the interest rate is high, you're gonna want to save that money. If they are low, then you withdraw that money, right? There's no point in saving it. The interest rate is determined or largely influenced by the central bank through its accommodation policy, the repo rate, right? So the interest rate is, okay, I said this already to say that the South African Reserve Bank uses the repo rate to influence the interest rate, right? Because if they increase the repo rate, which is the interest rates that is paid, that is charged to more commercial banks, right? Commercial banks are your Absa, Capitec, and so on. So if they increase that interest rate that is charged to the commercial bank, which is the repo rate, they will also do what? Increase the interest rate, which is the rate or the prime rate. It's called the prime rate also, which is the rate that is charged to what? To us, right? So the South African Reserve Bank uses the repo rate to influence what? The interest rate. And then we have no independent money supply curve. Well, we're supposed to explain this graph because we did it in the previous video. It's just the same thing to say that if the interest rate is here at I1, you see that the M0 is the demand for money. Yeah, the quantity of money which is demanded, it decreases. Oh no, if the interest rate is it's okay, let's start here. If the interest rate is I1, the quantity of money increases. The demand for money increases, meaning that the amount that people um they want to hold, it increases. But if the interest rate increases, okay, what are they saying here? If the interest rate increases, the quantity of money that one's hold will decrease. I don't know why the arrow is going this way. The quantity of money is determined by the interaction between the interest rate and the demand for money. At the initial rate of R0, oh, the initial was R0, okay. So at I0, if the interest rate is here, you can see that the M0 here is the quantity of money that people are willing and able to hold. But if the interest rate now decreases, the quantity of money that people are willing to hold is going to increase, right? Obviously, because the interest rate have decreased. Similarly, if the interest rate was here in I1 and then it went up to I0, you can see that the quantity of money that people are willing to hold is going to decrease from M1 to M0, right? Because interest rate are high. So people are going to want to save that money instead of what holding that money, right? Okay, no independent money supply curve, obviously because the supply of money is regulated by the what? The South African Reserve Bank. The quantity of money is determined by the interaction. Okay, they're repeating the same thing also here. Okay, you guys should know this by now. The quantity of money is determined by the interaction of the interest rate and the demand for money, right? Why? Because if the interest rate is high, the demand for money does what? Decreases. If the interest rate is low, No. If the interest rate is high, the demand for money will decrease. Yeah, because people want to save that money. But if interest rate is low, the demand for money will do what? Will increase. People want to hold that money because interest rate are low. Yeah. There is thus no independent money supply curve. Instead, the quantity of money depends on the demand for money and the cost of credit. Remember, the cost of credit or the price of loans or credits is what? Is the interest rate. Call the demand determinant money stock of endogenous money. Yeah, let's just, because they said explaining the same thing even there. Okay, assumptions, money supply is controlled by the South African Reserve Bank. This is what I have been saying, that the supply of money is controlled by the what? By the South African Reserve Bank. There is no relationship between money supply and the interest rate, right? The demand for money is equal to the supply for money, which is controlled by the South African Reserve Bank. Take note, the x-axis, these ones, will represent the y-axis, these ones will represent the interest rate, and then the x-axis, these ones will represent what? The demand for money or the quantity of money. And how is the monetary policy used? They can use the monetary policy in they can use the monetary policy. These are other policies of the monetary policy, which is the expansionary policy and the contractionary policy. We're gonna get to this when we get to, yeah, here, because I want to explain it there. Okay, the monetary policy. So now we're gonna look at the monetary policy. This is the policy of the what, guys? Of the South African Reserve Bank, right? This is used by the South African Reserve Bank to do what? To regulate the quantity of money that is in what? That is in in circulation, right? Oh, I'm sorry for doing that. That is in circulation. Right, so monetary policy can be defined as measures taken by the monetary authorities being the what? The South African Reserve Bank, to influence the quantity of money and the rate of interest rate with a view to achieving stable prices, full employment, and economic growth. Right. I think you have to know this. The monetary policy can be defined as measures taken by the monetary authority to influence the quantity of money and the rate of interest rate with view of achieving stable prices, full employment, and economic growth. And then, should I read this? In 1998, South Africa adopted the first inflation target, okay, which is 1 to 5%. However, this was short-lived as year 2000. The inflation target was adjusted to 3.6%. So the inflation target is 3 is to 6%. Right? So want to keep the inflation rates between 3 to 6%. Distinguish between expansionary and contractionary monetary policy. Right, we said that the policies under the monetary policy is the expansionary monetary policy and the contractionary monetary policy. And the three main tools of the monetary policy is the what? The repo rate, the open market operations or open market transactions, as well as the required reserve ratio. Right. So expansionary monetary policy. So this is how I like to explain this, right? It makes it easy for me to understand it. So I hope it's also going to help you guys. So you remember the business cycle, right? So I'm gonna draw a smaller business cycle here. This is the trend line. And then we have something like this, right? Something like this. Okay, so you know that let me just use a different color. So this, you know that this, we call it what? We call it the expansionary phase, right? And then, okay, let me just do this. And then this is the what? This one here is the what? Is the contractionary phase, right? Where economic activities are going down, right? So let me just do this. Okay, let me just, I'm gonna use this. And then just like that. Here. Okay, so would you guys see what I'm trying to do here? Okay, so when you look at your business cycle, right, you know that this part here is called the expansionary phase, right? Where we say Duguti, the economic activities are what are increasing, right? Because we have no, not necessarily full employment, but the unemployment rate is decreasing. People have consumption expenditure is increasing. We have economic growth. More goods and services are produced, obviously, because people are employed and all of that. Remember, when we're doing the business cycle, that's what we said with the expansionary phase, right? Ukuthi economic activities are high and all of that, right? So during this phase here, it is what is the expansionary phase, but in order now to do what? Because the economy is like, as I mentioned, Ukuthi have economic growth here, people are employed, consumption expenditure is high, and all of that. So to try now and slow down this growing economy, we can use what? We can use the contractionary monetary policy. So the reason why I circled contractionary is because this is an expansionary phase, but we are using what? The contractionary monetary policy, right? And also this side, this is a what contractionary phase where the economic activities are declining, right? Meaning that unemployment rate is high, economy the production is decreasing. What else, guys? What else? Um, Also here we experience inflation, prices are increasing, and okay, the side, okay, I said people are unemployed, people are retrenched, obviously it's unemployment. The economy, J, is declining, right? The economy activities are declining. So to try now and help to speed up the economy, we're gonna use what? The expansionary monetary policy, right? So that it can speed up and then reach this point again, where the economic activities start to increase. So this side is called the what? The contractionary phase, but we use what? The expansionary monetary policy. So now I'm going to show you how we use these policies, right? So here they're saying that the South African Reserve Bank will increase money supply in the economy, right? Will increase, no, I'm using the wrong color. So the South African Reserve Bank will do what? Will increase money supply in the economy, right? So remember I said, Duguti, this side here, people are retrenched, there is unemployment, um, production is decreasing, economic activities are declining. So to try and speed up the economy so that we can get to this point here where the economic activities start to increase again, the South African Reserve Bank will use what? The monetary policy, the expansionary monetary policy to try and increase money in economy, right? Because if money increases, it means that commercial banks are going to have more money and then they can offer credits. They can grant credits. If they grant credits, more businesses will be created. People will have more disposable income and so on. And then we will go, then the economy will do what? Will the economic activities will increase, and then it will come back to this, right? To this phase here, the expansionary phase, right? So in the expansionary monetary policy is used. This one is not, you don't have to know this, but you just have, it helps to know this so that you can be able to understand these things, right? That I'm about to explain now. So it helps to know that the expansionary monetary policy is used when the economy is in what? Is in a contractionary phase there in the business cycle, right? Where the economic activities are declining. So what would happen is that the South African Reserve Bank will decrease the repo rate. So if they decrease the repo rate, that is the interest rate which is charged to our banks, the commercial banks will also decrease the interest rate. If they decrease the interest rate, then it becomes cheaper to borrow money from the bank, then people are going to go and borrow money from the bank. But and then that will do what? It's going to increase the amount that people have, which will what? Increase consumption expenditure. So now economic activities were declining, right? But now because there's been a decrease in the interest rate, then people are going to start consumption expenditure is going to start increasing. Businesses are going to be established or built because people can borrow money from the banks to start businesses. And then if now there are businesses, people can be employed and all of that, right? Also, the buying of securities, bonds on the open market, right? So government securities include what? The stocks, which are like shares, the bonds, which are your long-term investment, and also treasury bills, right? But you don't have to know this. I'm just like saying it so that you guys understand. So your what happens here is that the buying and the buying of securities and bonds on the open market. So what happens is that when the South African Reserve Bank, right, when they sell these bonds or securities, it's like they issue a certificate, right, to say that you own this much at this company, right? For example. So they give you a certificate and you buy a certificate. So when you're buying a certificate, it's like you get that certificate and you pay money to the South African Reserve Bank. Right, that will do what? That will reduce the money that you have, right? Because what you're getting when it's just a certificate that you have this amount of shares in this type of company, right? You only have a certificate, but you gave them what? Money. So that will reduce the money that you have. So here they're saying that buying of securities. So since the expansionary monetary policy is used here in in the business cycle, in the contractionary phase, obviously economic activities are declining. Now, to try and speed up the economy, what would happen is that the South African Reserve Bank will buy securities. So now they would buy back those certificates that they gave to our commercial banks. So when they're buying those certificates, the commercial bank will give South African Reserve Bank a certificate, and the South African Reserve Bank will give them money, right? So that would increase the amount of money that banks have now. So now if banks have more money, obviously they want to increase the supply of money. If banks have more money, they can now do what? They can then lend that money to the public. And then that's how reserve ratios. So the required reserve ratios, it's basically the amount of money that banks are required to hold for them to stay solvent, right? So the commercial banks will say, Guti, for a bank to be solvent or to operate, they have to hold this amount of money. And that amount of money, they must not use it like to they must not use that money to give out to people like as loans and all of that, right? That's the amount of money that banks must keep for them to stay solvent, right? So let's say now, let me just make an example. Let's say um you have, I'm just gonna write here, let's say I wanna use 5,000 and then I'm gonna write here 3,000, 1, 2, 3, and then 2,000. 1, 2, 3. Okay. So the cash, the cash reserve ratios, and remember I said it's the amount of money that banks are required to hold, right? So let's say, good team, um, let's say the South African Reserve Bank says that this bank has 500,000, right? And they say, good team, you should hold three thousand, right? Meaning that this bank, it has what? It has only 2,000 that it can use in order to do what? To it can use to do what? To offer credit to people or to make loans and so on. The 2,000 is the amount of money that banks can actually use or is in circulation, because this one is the cash is reserved, right? So if now during this phase, the contractionary phase, economic activities are declining, right? We want to stimulate these economic activities. The South African Reserve Bank will use the expansionary monetary policy and decrease the required reserve ratio. So now, if they decrease the required reserve ratio, remember I said Uguti, the banks were required to hold what? 3,000. So now let's say now the banks are required to hold 2,000. So it means now they have how much? They have 1,000 extra that they can use what in circulation to do what that is in circulation and that they can use to offer AMA loans and credit to us, to the people, right? So now, if the cash reserves, if the South African Reserve Bank decreases the cash reserves, it's going to increase the money that is in what? That is in circulation, that is in the economy. And then if there's more money, banks will offer more money to, will grant more credits, and then people have more money, and then what happens that consumption expenditure increase and all of that, right? Here in the contractionary phase. Right. So what you have to know is that the expansionary monetary policy, it is used to increase the money supply in the economy. And then you can just draw this business cycle if you want to remember it. And then obviously you know that this side is the expansionary phase and this side is the contractionary phase. So in the contractionary phase, they use the expansionary monetary policy. And in the contractionary phase, in the contractionary phase, they use the expansionary monetary policy, and in the expansionary phase, they use the contractionary monetary policy. Did I say that right? But you guys can see here with the colors. Also here, if now we are in the expansionary phase of the business cycle, right? Meaning that the the economic activities are increasing. We have people are employed. Consumption expenditure is increasing. People are demanding goods and services because they have more money and it's about they're employed, right? Consumption expenditure is increasing, and what else? And all those other economic activities, right? So to try now and slow down this increasing economy, the because there's more money in circulation, right? And this would also lead to inflation. Remember, I said it people have more money, right? It will also lead to inflation where prices are going to increase because producers are trying to discourage this demand for goods and services. Excuse me. So they can then use the contractionary monetary policy whereby now they decrease the money supply, right? Where now they do what? They decrease the money supply. So by doing what? By increasing the repo rate. So if the South African Reserve Bank increases the repo rate, the commercial banks will also do what? Will also increase the interest rate. So if they increase the interest rate, it becomes expensive for us to borrow money. Credits becomes expensive, right? So people no longer take out loans and all of that. So it reduces what the amount of money that they have, right? And also sell securities, right? Whenever you say securities or bonds, just think of a certificate. So what happens here is that the commercial bank will sell a certificate, right, to the commercial banks. So when the South African Reserve Bank gives this certificate to the commercial banks they would buy it, right? They would pay money to the what? To the South African Reserve Bank. So that will do what? That will reduce the amount of money that commercial banks have. Right, and they'll only get a certificate which basically said that you have this amount of shares in this amount of company, right? Something like that. So now if the money that the commercial banks have has been reduced now because of they they bought these securities, then it means they're gonna have less there's going to be a decrease in the money circulation and then less money to offer or to make available for what for loans and for credit. And then increase the required reserve ratio. So let's say that um, banks were required to hold 2,000, right? And then now the commercial banks sees there's too much money in circulation. Let's try to decrease the amount that is in circulation. Then they do what? Then they increase the reserves requirement, right? So if they increase the cash reserves from 2,000 to 3,000, banks are going to have what? Less money to do what? To borrow. Because now they're going to have what? 2,000. Right, to lend out to the people. Okay, so you guys get this one. If you didn't understand, please stop the video and then, yeah, make sure that you understand it because I'm sure it is important. So yeah, you just have to know if you understand the business cycle, you can do it the way I do it. But if you don't, you can just try to, I don't know. But in the business cycle, we have the expansionary phase where economic activities are increasing. Yeah. And in that phase, we use the contractionary monetary policy. So just think, okay, when the economic activities are increasing, right, that is the expansionary phase. So obviously we use the contractionary monetary policy. So what can we do to now reduce um or to slow down this increasing the increasing economic activities? How can we do to slow down this growing economy? We can increase the repo rate because if we increase the repo rate, if the commercial banks are going to increase the interest rate, and people are going to have less money because they won't be able to borrow money, right? Or they can sell securities. If they sell securities, the commercial banks, they buy these securities. When they buy these securities, they pay. So it's going to reduce the money that they have, right? Or they can increase the required reserves. If they increase the required reserves, banks are going to have less money, which reduces the money circulation, right? Same thing applies. So it's okay in the business cycle, we also have what? That phase there, which is the what? The contractionary phase. In the contractionary phase, they use what? The expansionary monetary policy, right? It's the opposite. So what is happening in the contractionary phase? Economic activities are declining, right? So what can we do to try and stimulate economic activities because they are declining? We can decrease the repo rate. If the commercial South African Reserve Bank can decrease the repo rates, if they decrease the repo rates, what is going to happen? The commercial banks will decrease the interest rate. If they decrease the interest rate, are going to do what? To borrow more money. More jobs will be created value because some people they don't have money to start these jobs. They can only start them by doing what? By using loans, taking out a loan and then creating a job, right? And then they could also buy back securities. If they buy back these securities, they take their certificates and they give us money. And they give the commercial banks money. So they're going to be what? An increase in the money, which is in circulation. Or they can decrease the required reserve. If they decrease the required reserves, banks are going to have more money to do what? To lend out to people, right? So, yeah. The main features of the South African monetary policy framework. The ultimate objective is balanced and sustainable economic growth. The intermediate objectives is pre-announced inflation targets, the operational variables of short-term interest rate, which are governed by the changes in the repo rate. The monetary control system is a classical cash reserve system. The main elements of a classical cash reserve systems are the minimum cash reserves requirement of 2.5% of the bank's liability. So you know that the cash reserves obviously is the amount of money that banks are required to hold in order for them to stay solvent, right? So they're saying that it's supposed to be 2.5% of the bank's total liability, meaning that for every customer which deposits money in the bank, they must hold 2.5% as what? As a cash reserve, right? To ensure that the bank stays solvent and that they're able to cover their debt in the long run. Various policy instruments, such as the open market transaction or open market operations, are aimed at creating a persistent liquidity requirement, also called the money market shortage. So this liquidity in this context refers to banks' balance at the South African Reserve Bank that are available to settle their transactions with other banks. So this liquidity is to ensure that liquidity to ensure that banks are able to cover their debt, right? Banks have to hold a certain amount of money to ensure that they are solvent. For anything that might happen, they have money, right, to cover their debt or like in unforeseen circumstances, for example, like for COVID-19, right? What happened during COVID-19? I don't even know what I'm going to say. But let's say that there's a situation where now the bank is um experiencing financial crisis, for example, maybe there's a person that came and stole money from the bank, right? Let me just make an example. So having liquidity or having cash reserves, it's going to help them to be able to cover those debt, right? And to pay people back their money, right? Because the cash reserve essentially is the amount of money that banks are required to hold for them to stay solvent. And that money is kept where? With the South African Reserve Bank, right? It is kept there, right? So if something happens to the bank, they can still use that money to pay back people, right? Monetary policy is implemented through various instruments. So the instrument of the monetary policy is the repo rate and the cash reserves requirement, the accommodation policy. When a bank experiences, okay, here they're gonna say the same things that I said here, guys. Yeah, but let me just let's just do it. So when the bank experiences shortfalls of cash reserves, funds can be obtained from the Reserve Bank at an interbank overnight rate. Okay, it's not the same thing. Okay, so when the bank experiences shortfalls or shortages, the banks can borrow money from the cash reserves, from the Reserve Bank, right? And if all banks have the same liquidity problem, the Reserve Bank as a bank acts as a lender of the last resort. So if banks also do not have money, they can borrow money from the what? From the Reserve Bank. Last resorts basically means ukuthi they must have tried other means of getting that money, right? And then if they can't get it from anywhere else, they can then go, okay, to the what? To the South African Reserve Bank. Through the repurchase tender system, which is the repo system, liquidity is provided to the banks by means of repurchase agreement between the Reserve Bank and its banking client. So they're saying basically here that they use the repo rate. Obviously, you know that the repo rate is the interest that is charged to commercial banks. So when commercial banks borrow money from the Reserve Bank, they are charged the interest rate, which is called the repo rate or the repurchase rate. Also have open market policy. Okay, when you see this one, open market transaction, operate market operations, just think of bonds and securities. Entails the sale or purchase of financial asset by the central bank to exert the desired influence on the interest rate and the quantity of money. The central bank uses open market transaction to ensure such persistent social shortages of liquidity. So they will use the open market transaction to do what? To create a shortage. Right. For example, they will sell government bonds. So if they sell government bonds, remember what I said, Roots, if they sell government bonds, we buy these bonds, right? Okay, not we, the commercial banks, they buy these bonds and they get a certificate to say, Roots, they own this amount of ban. And then what they do is that they're gonna pay money to them. So if they pay that money, it creates what? A shortage, right? It reduces the money that is in circulation, right? And then also if they buy government bonds, excuse me, the central bank, the South African Reserve Bank, oh yeah, it is a central bank. The South African Reserve Bank will do what? Will buy back these government bonds. So taking back that certificate and giving them money, which will then create money, right? Which will then increase the money that is in circulation. So other instrument we have a credit ceiling, exchange control regulations, and moral suasion. Right. Bank supervision. Okay, so here let me just explain the moral suasion. Moral suasion is basically when the banks will just the commercial bank will talk to to the no the central bank, South African Reserve Bank will actually persuade the commercial bank to act in a particular manner, right? They'll just persuade them or like talk to them. Bank supervision. Banks need to adhere to various requirements with regards to their capital and liquid asset holdings, in addition to the 25% cash reserve requirement. Right, capital requirements. This is to ensure that banks do not become insolvent or take excess leverage. So the capital requirement, it's there to help for them to not become insolvent, right? So the commercial banks will require that bank have assets, right? As a bank, you need to have assets that you own so that if things happen, at least you are not what you are able to pay back that your clients, give them back their money. Liquid assets requirement, assets that can be converted into cash in a short time with little or loss or no loss in value. So they also say that you need to have like the liquid assets, meaning that asset that can be converted into cash so that when if anything arises, the commercial bank can sell those assets and then can get money to pay back the client. Okay, okay, we are done. I hope you guys understood everything that I said. Let's now try to do these questions. So they're saying here, number one, if the Reserve Bank wants to pursue a contractionary monetary policy the bank showed, here's what I'll do first is I'll just draw my mini what's this? Business cycle. Then I'll do this. Then I know if they're talking of the con oh my goodness. If they are talking about the contractionary monetary policy, this one is used when it is used here, right? No, hey. How, guys? The contractionary monetary policy, you're going to use it here, right? When the economy is what? It's increasing, right? When the economic activities are increasing, right? Because this side is called the what? The expansionary phase. So in the expansionary phase, we're going to use what? The contractionary phase. Then I'm going to ask myself, what is happening in the expansionary phase? Economic activities are increasing, people have jobs, we have inflation. Um, so what can we do now to slow down this growing economy? I think we would have to do what to increase the interest rate. Let me just read here. Because you know the instrument used by the monetary policy is just the repo rate. It is the open market operations and the what and the cash reserves, right? So this side, you know, good thing. In terms of, because you see here we have interest rate. In terms of the interest rate, we'll have to increase the interest rate so that people have so that loans become expensive, right? And security. So with the securities, the South African Reserve Bank will need to sell securities because if they sell securities, commercial banks will buy the certificate and give them money. That will reduce the amount that is in circulation, right? Because here essentially we're just trying to reduce money that is in circulation. So let's look for those answers. So you're saying here, raise the interest rate and sell securities. Yeah. So the answer is A. Number B, okay, let me see which one would be this side here. The contractionary phase where they would use the expansionary monetary policy. Here, this side, it would be to do what, guys? To decrease the interest rate, right? So that people can borrow more money. And in terms of the securities, obviously they'll have to buy securities. So the answer would be this one. But for this case, the answer is A. Okay, number two, which of the following will lead to an increase in the demand for money? Remember, we said the demand for money is the what? Is the quantity of money that people are willing to and able to hold. And that is dependent on the interest rate, right? So they're saying that increase the interest rate. If the interest rate increase, would you want to hold more money? I don't think so. The demand for money will decrease because the interest rate will increase, right? Because you would want to save that money so that you can get more interest on your investment, right? So you want to save it. So this is not the correct answer. Decrease in supply of money cannot be anything that has to do with supply. Because remember we said the demand for money is independent on a supply, right? It's dependent on the interest rate, right? Is it dependent or we said it's 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 influenced, but yeah, it goes with the interest rate and not with the supply of money. So B is also not correct. A decrease in the price level. So if prices decreases, you will not demand more money. There won't be an increase in the demand for money. Because if prices decreases, it means the money that you have is just enough for you to buy these goods. It's even extra because prices have decreased. But if they said prices increase here, it was going to be number C. Because if prices increase, then you're gonna demand more money because prices have increased. So let's say, for example, you had 10 rand, and with the 10 rand, you were able to buy one loaf of bread, right? But now if the price of bread becomes 20 rand, it means now you're gonna need what? 20 rand to buy a loaf of bread. So you're gonna demand more money. So if prices increase, the demand for money increases. So this one is not the answer. So the answer is D, an increase in the level of aggregate output. Aggregate output, remember aggregate, I said it's total. So if there's an increase in the total production, output, obviously they're talking about production. So if there are goods, the goods that have been produced increases, the demand for money is going to increase because more goods have been produced. So more money is needed to do what? To buy those goods. So the answer is D. And then if the central bank sells government securities in the open market, the supply of money will. So if they sell securities, okay, let's see. Selling of securities, it means that they sell these certificates. Whenever you see guys securities, just think of certificate. It makes it easy to interpret whatever you want to interpret. Like how I'm going to do it now. Okay, let's do it together. So let's say if they sell government securities, right? The central bank it just refers to the South African Reserve Bank. So if they sell securities, they're going to do what? To give more commercial banks the certificate. Right. And the commercial banks are going to buy this certificate. So what is happening? Money is leaving. The economy, obviously, money that is in circulation will decrease because commercial banks are going to give this money to the central bank, and the central bank will give them what? The what's this? The certificate. So what was the question? If the central bank sells government securities in the open market, the supply of money will it's going to decrease. Right. So the answer here is B. Right, guys, did you get that? Because if they sell securities, banks will buy a certificate and they will give them money, right? So essentially, the money that now banks have will decrease, right? So it should decrease the money that is in circulation. The answer is B. The repo rate is, you guys know this one. So the repo rate, I've been saying, it's also called the repurchase rate. It's the rate that the commercial banks, sorry, the South African Reserve Bank charges to what? To the commercial banks, right? So it's the interest rate at which commercial banks lend to the public. No, this would be what? The prime rate. And then interest yield on government bonds. No. Interest rate at which reserves bank lends to commercial banks. Yes. So the answer here is C. Which of the following statement is correct? The answer is D. Money in South Africa is not backed by gold, right? It's not backed by gold. The the value of money in South Africa or the value of the rand is determined by the supply and the demand in the foreign exchange markets, right? So it is not backed by gold. So the answer here is D. Number six, which of the following is not a function? I didn't go through all of this because, yeah. Which one of the following is not a function of the South African Reserve Bank? It's not a function. Okay, they formulate and implement monetary policy. Yes. They maintain financial stability. Yes. To provide economic and statistical services. Yes, where we say duty, they gather data and collect data and all of that. They act as a banker to other banks. Yes, and also a banker to the government. To finance government expenditure? No. So the answer here is E. The repo rate is, this question is repeated. Let's just look for an answer. The best interest rate investor? No. The rate at which South African Reserve Bank advances loans to the government? No. The rate at which South African Reserve Bank provide loans to other banks? Yes. The answer here is D. When inflation rate is expected to exceed the target rate by a significant margin, the South African Reserve Bank will tend to do what? So, when the inflation rate increases, it means a good thing. Um, when the inflation rate increases, is when the inflation rate is expected to exceed the rate by a significant margin, the target rate by a significant margin, then the South African Reserve Bank will tend to reduce the cost of credit to banks. What will cause inflation? Inflation will be caused by what? People having more money, right, in their hands. Because if now they have more money, the demand increases. Then if the demand increases, the the producers they'll increase the price of goods and services, which will lead to inflation. So to try and reduce that, the commercial banks would have to do what? Would have to increase the interest rate so that they can reduce the amount of money that people have, so that they can reduce their demand, right? Yeah, so the answer here is B because an increase in the repurchase rate. Because if the South African Reserve Bank increased the repo rate, the commercial banks will increase the interest rate. And then if they increase the interest rate, it becomes difficult for people to borrow money, which will then reduce the amount of money that they have, which would, excuse me, which will then reduce what's their demand, right? So the answer here is B. Oh, okay. So we're not going to do these questions because I have an activity that I'm going to do. Maybe I'll also do this ones also. So thank you guys for watching and also just for being patient with me. I know, Guti, I didn't post the entire week. I've been busy, guys. I've been writing. But yeah, I was just thinking of you guys like the entire week. Guti ish, I need to post for my study buddies, you know. But yeah, guys, I hope you guys learned something from this lesson. And if you have questions, you can like or any query, you can just post them on the comment section. Right. I wish you guys all the best as you guys are preparing for the semester test. Remember, guys, you've got this.